Okay, well, first of all, thanks very much for the invitation. It's really encouraging to see the interest that's being generated both here and in the US and Britain, and obviously other places as well, in terms of MMT ideas, which are clearly now getting some traction. And after being involved in developing these ideas with Bill and others over many years, it is most gratifying to realise that people are taking the ideas seriously. Okay, the topic is challenging the dominance of monetary policy, and it's a highly relevant topic currently because of the debates going on about the future of macroeconomic policy. The talk is quite long. I shall attempt to not drone on forever. I may cut a bit towards the end, but the slides will be available, no doubt, on the website. Now, the starting point really is Milton Friedman. And he really was one of the most influential macroeconomists of the 20th century. Very much free market, very hostile to government, as you can see by the first quote there, and had a particular belief about the effectiveness of monetary policy. He worked with Ed Phelps and really established monetary policy as the primary arm of macroeconomic policy. As I say, he was very hostile to government. He believed the free market system worked, and therefore the onus on government really was to create the conditions for a free market economy. So limited regulation, achievement of low inflation, minimal government role in the macroeconomy in terms of taxing and spending. And there's a sort of echo of that if you look at the title of the Morrison tax legislation, which is all about people retaining as much of their income for their own choices about spending and tax rates being reduced. So government creates the appropriate conditions, and then the market system, through flexible wages and prices, will lead to different markets clearing, the labour market, product markets, and so on. And the outcome will be some notion of full employment, which, as far as Friedman was concerned, is called, well, the natural rate of unemployment. And when economists talk about anything natural, one should just take a deep breath and be a little wary of what they're on about. Now, the emphasis on inflation was all about creating the conditions within which households and firms could make sensible decisions. And this obviously makes some sense. If the inflation rate is moving around, then it's very difficult to make decisions about investment and so on, and even decisions about taking out a loan for consumption purposes. So in their work in the 60s and 70s, Friedman and Phelps argued that monetary policy was the tool to control inflation. And, of course, this view has remained a very powerful view and a very influential view amongst orthodox economists, even in the aftermath of the GFC. By the way, if there are any questions along the way for clarification, I'm happy to answer them. Obviously, I don't want to engage in some debate about some esoteric point during the talk, otherwise I may not finish the talk.
We will have a Q&A.
Oh, for sure. Yeah, oh yes, no, I appreciate that.
Yeah.
Okay, so initially monetary policy was conceived in terms of a central bank setting a target rate of growth of the money stock. And that didn't last very long because in the 80s, for reasons which I'll explain later, targeting some quantum of money was rejected Simply central banks couldn't do it. And that's when the target of monetary policy became a very short-term interest rate, the overnight interest rate. Now, the cost of adopting active monetary policy since the 70s has certainly been higher unemployment, lower growth, and than in the immediate post-war period, and I'll have something to say about that in a moment. And post-GFC, we get a similar suboptimal economic performance. Low official interest rates has been the policy response, but again, stagnant GDP, and in fact, very low inflation rates. And this has led to a desperate search for other ways of conducting monetary policy, so-called unconventional monetary policy, both quantitative easing, which has been enacted in those countries shown on the screen, and to a small degree, negative interest rates in Japan, Eurozone, and Switzerland, and other countries too. And the objective there has been to further reduce interest rates. So if you like, the conventional monetary policy of simply lowering a target rate doesn't seem to have worked terribly well. So there's this desperate resort to further cuts, even into the negative domain, to demonstrate that monetary policy in fact does work. And indeed now there's talk, and I won't have much to say about it, of deep negative interest rates, which raises all sorts of questions. Certainly central bank governors, including Mark Carney, Bank of England, and Philip Lowe, who you all know, well, not personally, they have attempted to argue that, and have, in the case of Philip Lowe, been somewhat constrained by the politicians. They've attempted to argue that, in fact, monetary policy by itself isn't going to address the economic conditions that currently prevail. So I'm going to attempt to answer three questions in this talk. Firstly, why has monetary policy been the dominant arm of macro policy for this very long period? Secondly, a quick guide to how these other forms of monetary policy, the unconventional monetary policy, how they are conducted. And thirdly, is there a role for a zero interest rate policy, which is referred to as ZIRP, or negative interest rates as part of a broader macroeconomic policy framework, with the objectives being full employment and price stability. Now, I'll come back to what I mean by price stability in a moment. So I shall be attempting to go through all that, which looks quite ambitious. We'll see how we go. So first of all, it's very important to understand what we mean by inflation. And the critical point is that inflation is an ongoing increase in the price level. It is not a one-off increase. And a good example of this is the introduction of the GST, which obviously led to an increase in prices, with 10% being added on, or some fraction of 10%. So there obviously was a one-off increase in the price level, and the question then was, would there be further increases because workers would be upset with the CPI going up? Does anybody know why it was one-off and it didn't continue? What was the quid pro quo that households got when the GST was introduced? There were tax cuts. So if you look at the CPI figures, it's clear that there wasn't any reaction from Labour broadly when the GST was introduced. Now, So inflation is an ongoing increase in the price level, and it is really the result of ongoing conflict between workers and firms over income shares. And economists identify two initiating forces as being some form of demand pull, which means the economy is very close to full employment and labour shortages are starting to appear and wages are getting pushed up. Those wage increases feed into prices. There may be perhaps raw materials are rising in price, and it's a product of the economy being very close to full employment. The other initiating source of an inflation is so-called cost push, and that can take many forms. For example, if you have a severe drought, then of course food prices are likely to rise. That feeds into the CPI. That may give rise to workers pushing harder for increases in money wages. The example that's relevant to the rise of freedmen was the OPEC crisis, which I'll come on to. It does take two to tango for an inflation process to keep going. So if workers stop pushing to restore their real wages, in other words, the capacity of their wages to buy certain quantum of goods, if workers give up, then the inflationary process is likely to cease. If firms, having faced money wage increases, then don't push up their prices to restore profit margins, then the price setters have given up the fight and the inflationary process has essentially ceased. Very important in talking about inflation, of course, is to reflect on changes in industrial relations. In other words, the power of workers to actually achieve their demands in terms of money wage increases. And of course, over the years, workers' capacity to strike has been severely curtailed, and there's obviously the forces of globalisation as well in terms of international competition has to be taken into account. So workers are much less capable of really pushing hard for money wage increases. Now, often a response, irrespective of its source, a response to inflation is government simply engages in contractionary policy. So a bit of unemployment deters workers. Falling demand for goods may well deter firms in terms of firms pushing up prices and workers trying to push up money wages. Another response, of course, is some form of incomes policy, and that was enacted successfully from an inflation point of view under the Hawke Government Accord around 1983. Now, I'm now going to move to some theory, which is probably the most technically difficult part of the talk, because I really got to demonstrate why Friedman's ideas gained such kudos in the early 70s. So in the post-war period, there was essentially a Keynesian consensus that there was a role for fiscal policy to keep unemployment low, and essentially employment was determined by effective demand. And the national account statisticians divide total spending up between these different components: private consumption, private investment, government expenditure, and net exports. So we take off imports, which can be part of private investment, can be part of private consumption, and so on. So The idea was that if there was an excessively high level of unemployment, then government would stimulate the economy either by tax cuts or increases in government expenditure. And it was argued that as unemployment fell, then there would tend to be higher inflation. And an argument put forward by Lipsey, a Canadian economist, was that as different sectors faced bottlenecks, in other words, shortages of labour, possibly of raw materials, then prices would start rising before some notion of overall full employment had been achieved. So here we're developing an idea of some sort of trade-off. So high unemployment would give rise to low inflation, but as unemployment fell, inflation would increase. And this idea of a trade-off gained empirical support from a New Zealander, Bill Phillips, who found a stable inverse relationship or trade-off between the change in the money wage and unemployment. So again, as wages grew, reflecting increasing demand and lower unemployment, then, I should start with unemployment. As unemployment fell, workers would be in a better situation to push for higher money wages. And one can translate that relationship between wages and unemployment, or change in wages and unemployment, to a relationship between price inflation and unemployment. Obviously, it depends on firms' pricing behaviour, but I won't go through that detail. So to illustrate the idea here, we have the unemployment rate on the horizontal axis, the rate of price inflation on the vertical axis, and the argument quite simply was as the unemployment rate decreased, which is not the way the arrows show it, by the way, so becoming in this direction, then the rate of inflation would rise. And this trade-off meant there essentially was a menu of policy choices for government. They could choose relatively high unemployment and therefore low inflation, or they could choose a lower rate of unemployment and accept the fact that they would have higher inflation. And these were stable configurations, so you could sit quite happily at 4% and experience 4% unemployment and experience 3% inflation on an ongoing basis. And government would use fiscal policy to push the unemployment rate in the desired direction. So this was the basis of post-war macroeconomic policy, and fiscal policy had a role. Now, this trade-off was undermined by the OPEC price shock, so the Organisation of Petroleum Exporting Countries. That occurred in 1973, and there was a fourfold increase in oil prices by 1974. And clearly a rise in the price of oil has a very pervasive effect on prices generally of final goods. Obviously the price of oil, petrol, which you buy as a final consumption item to fuel your car, went up, but most goods in particular have some component associated with transporting them from A to B. Now, at the time, of course, industrial relations legislation was such that unions had considerable power, and they successfully negotiated for higher money wages because their real standard of living was being diminished by the rise in the consumer price index. And this in turn led firms to restore their profit margins because the unit labour costs have gone up by raising their prices. As was typical, government responded with tight fiscal policy, but really that didn't deter the inflationary process because it was came from an external source, the OPEC countries. The OPEC countries weren't concerned whether governments were engaging in tight fiscal policy or what they were doing. The OPEC countries were very keen to establish higher levels of prices for oil. So the inflationary process was not much affected by the tight fiscal policy, so we then had a situation of continuing quite high rates of inflation but higher unemployment. And so the idea of a trade-off was contradicted. And of course the presence of both high rates of inflation and high unemployment is referred to as stagflation. So this contradicted, as I say, the idea of a trade-off. And this is really explains why Friedman's ideas, which I'm going to try to explain next, became so important and influential. Now, Friedman and Phelps were already developing the so-called expectations augmented Phillips curve. So the Phillips curve was the simple trade-off, and here Friedman and Phelps were adding a couple of additional ingredients because they challenged the idea, essentially, that there was this trade-off, and they were developing these ideas before the oil price shocks, so obviously it looked as though they had anticipated the breakdown of the Phillips curve, the stable relationship. So there are two key ingredients of the theory. Firstly, this idea of a natural rate of unemployment, the idea that if there is limited or minimal regulation and markets are allowed to work, then the economy will settle at some full employment level, but referred to as the natural rate of unemployment. And the more so-called market imperfections, such as minimum wages, rent ceilings, agricultural price supports, the more of those sort of imperfections, then the higher the natural rate would be. If the unemployment rate was moving around, according to this theory, the natural rate would be unaffected because it purely reflected the so-called market imperfections which prevent markets operating properly. Now, what we'll show is that this natural rate is a barrier to lower unemployment, and governments that try to reduce unemployment below this natural rate create major problems. Now, one crucial feature, of course, of this model of inflation and indeed the policy implications that follow is that the control of inflation is reliant on a so-called unemployment buffer stock, which is in stark contrast to a job guarantee, which I'll talk about very briefly. So let's have a look, and this is perhaps the most difficult part of the talk. We assume the unemployment rate is sitting at its natural rate, and there is 3% inflation built in. And let me do a bit of clicking. Here we are. Sorry, I should have labelled this axis. This is the unemployment rate along here. NRU could be 5%. We consider a scenario at point A, and what we have here is 3% inflation. Everybody understands the inflation rate is 3%. Everybody modifies their behaviour. You like your money wages going up 3%. Prices go up 3%, and everybody lives happily ever after. There's no labour market pressure, because this is precisely where the economy settles. There's no excess demand, of course, markets clear. And then an unwise government decides that this rate of unemployment, let's say 5%, is politically unacceptable, and elections coming up, and they're likely to get booted out if the unemployment persists at 5%. So what they do is try to reduce the rate of unemployment by fiscal policy. And we've got 3% inflation already. With the unemployment rate going below its natural rate, then that will increase the inflation rate, because now labour markets are getting excessively tight. There's excess demand in the labour market, and it may be the case that, say, the unemployment rate rises to 4%. And also wages rise 4%. And workers will think that, in fact, their real wages have increased because their behaviour is based on an expectation that prices have only risen 3%. So their money wages increased 4%, prices have risen 3%, so they actually have got a higher real wage, and they're prepared to supply more labour. So what we end up with is a situation like that, where to get to U1, we actually find an increase in the inflation rate because of this pressure supplementing the existing 3% inflation, and workers in the short term being convinced they're better off and being prepared to accept, offer more labour, and yet the rate of inflation is now higher than what they expect. So what they do is, in time, realise that, in fact, the rate of inflation is higher than expected, and this leads to a shift of what is essentially a short-run Phillips curve. I mean, it looks like the stable trade-off, but it's founded on a particular expectation of the rate of inflation. So the SRPC 0 is based on 3% inflation. So now workers come to their senses and realise that, in fact, the rate of inflation is 4%, and so this short-run Phillips curve shifts up. So the intercept now is 4%, and what this tells you is if governments want to sustain this lower rate of unemployment, this U1, then they've got to expect a rate of inflation which is substantially higher than 4%. And this process would just keep ratcheting on, with workers' expectations of inflation adjusting with a lag, because we assume they're adaptive, they don't respond immediately and know what's going on. And government very quickly realises that it is unsustainable to keep the unemployment rate down at U1. And essentially workers do require, as I say, a higher real wage to keep them at U1, but the problem is that this is just going to lead to an ever-accelerating rate of inflation as we move higher and higher up the vertical line at U1. So essentially, sustaining U1 is disastrous, and this shows that active fiscal policy, using fiscal policy to manipulate the unemployment rate, simply doesn't work. And I mean, from a sort of point of view of strategy, then it's a quite persuasive story. Fiscal policy has no role in addressing inflation, at least when you're trying to reduce the unemployment rate. If you want to bring the inflation rate down, yes, you've got to adopt contractionary policy, but there is no role for expansionary policy in this world where the economy settles at the natural rate. And so there's no essential role for active fiscal policy. In time, wherever the economy starts from, it'll find its way back to the natural rate, or very persuasive. So stable inflation, as I say, is only associated with some point on the NRU, and its rate will depend on past history. And if governments have been silly and tried to reduce unemployment, we might be at C and we would come down to 4% inflation, and if that was too high, we'd have to engage in contractionary policy and expectations would adjust downwards. So the only way to reduce unemployment in a sustainable way was free market reform. Get rid of some of those imperfections, get rid of minimum wages, which obviously create unemployment according to the market model, get rid of rent controls, etc., etc. And following on from that, of course, there were two important governments which were elected in the aftermath of Friedman. One was Reagan, who was very much a free marketeer, and the other was Margaret Thatcher. And they were very much influenced by the neoliberal ideas of Friedman. Now, how was monetary policy conducted according to Friedman? Well, monetarists argued that maintaining price stability, which doesn't mean constant prices, but a low and stable rate of inflation. So that was the key. The market system would address the unemployment issue, the economy would settle at the natural rate. All we needed to worry about was what rate of inflation was associated with the economy happily settling at the natural rate. Now, there is this so-called quantity theory of money, which is built on an identity. And the identity is about some measure of a quantum of money, the so-called money stock, which we can define as simply current account deposits, the sort of deposits that everybody's got, plus the money or cash in circulation, literally the notes and coins that are held essentially by the private sector. The view was that the central bank could control that quantum. And if you multiply that measure, which is a stock, something you measure at a point in time, by the number of times money circulated, say per year, in other words, changed hands, in the generation of annual GDP, the total value of goods and services produced, then the product of M and the so-called velocity of circulation would be precisely the value of nominal GDP. So if we then tack on that the velocity of circulation is constant, the number of times money changes hands over a year is constant, then, and if we assume that the economy is sitting at the natural rate of unemployment, then essentially changes in the money stock, growth of the money stock, will drive the price level. So with an identity, it's now no longer an identity because we've put a behavioural assumption in, and the behavioural assumption is that velocity is constant. What we can say, and this is purely algebra, is that if V is constant, then the growth of the left-hand side, which is simply M, since V is not changing, will be equal to the growth of the price level and the growth of real GDP, where you've stripped away changes in the price level. So if full employment output grows at 2%, and output grows because you may have more workers employed from one year to the next. I mean, a growing labour force leading to higher employment. And you've also got productivity growing. So if full employment output grows at 2%, and say the inflation target is 3%, then the central bank has got to increase the money supply by 5%. And it's assumed to have the capacity to do that. And in 1975, when I actually arrived at Monash, two major economic figures were present in Australia for a time. One was Jayne Robinson, who was a very famous Cambridge economist who knew Keynes, and the other was Friedman. And Friedman was spruiking his monetary rule and trying to persuade central banks to engage in so-called monetary targeting. So in this instance, the central bank must target a 5% growth in the money supply, which at the time it was felt that they had the capacity to do that. And in fact, it was readily discovered that they didn't. So, can the central bank target the money stock? Well, the answer to that is fundamentally no. Velocity, for a start, is not constant. And that stock of money, in other words, the bank deposits and the cash that people hold, is not controlled by the central bank. And the experiences of central banks trying to adopt Friedman's recipe, his formula, the performance of central banks was very poor. They were unsuccessful in targeting the money supply. And in the 80s and the 90s, central banks gave up trying to target money stock, and that's when interest rate targeting appeared. So targeting a short-term rate. But at the time, there was no real challenge to the idea that, in fact, perhaps not only should one ditch targeting the money stock, one should ditch monetary policy as the main arm of macro policy. This was despite the fact that it was readily conceded that monetary policy had actually uncertain effects. So the impact was subject to long and uncertain lags. And the classic example to illustrate this idea was when Keating had the recession that we had to have in the late 80s, early 90s, when there were increases in the cash rate, and I'll come on to the cash rate more formally in a minute. There are repeated increases in the cash rate, very little response from the macroeconomy, which encouraged more increases, and of course mortgage rates got up to 15-18%, because it wasn't appreciated that actually changing interest rates doesn't instantly change the operation of the macroeconomy. Interestingly enough, despite the failure in terms of monetary targeting, over time the powers of the central bank have increased. And in advanced economies, most central banks are allegedly independent. And it's the board members who meet every Tuesday in Australia who make the decision about the cash rate. And that's supposed to be at arm's length from politicians. And similar principles of course, apply in many other countries, including the US Fed. But with Jerome Powell, those of you who follow Trump would know that Trump seems to be trying to influence monetary policy. He's always bashing Powell, even though the US have just cut rates again because they're not cutting them fast enough. And so that is would be viewed in this country as not being consistent with having an independent central bank. Okay, now one other issue relating to the so-called expectations augmented Phillips curve is the idea that there is this natural rate of unemployment to which the economy converges, and it doesn't depend on the business cycle. It doesn't depend on what's happened to the unemployment rate over time. So obviously from a policy point of view, it was important to know what the natural rate was. And so the natural rate would be estimated by using sophisticated econometrics, and the typical estimates tended to follow the actual rate of unemployment. And that clearly was not consistent with the idea that the natural rate was in fact a product of these market imperfections, which was stopping the economy working more effectively. So the fact that the natural rate followed the unemployment rate made it clear that the natural rate was not independent of the cycle. It was not simply dependent on these market imperfections. And Bill Mitchell did work well over 30 years ago now, emphasising the idea of what's referred to as hysteresis. And what is being referred to here is the idea that the history of the economy is important. So if you've had a prolonged recession for 5 years, then typically you'll have a very large number of long-term unemployed, because clearly as somebody's duration of unemployment increases, they become less and less attractive to a prospective employer. The prospective employer will say they haven't been picked up by an employer a year ago or 2 years ago. They're still unemployed. There's probably something undesirable about them from the point of view of employment. Now, long-term unemployed are clearly, from an employer's point of view, fundamentally different than somebody who lost their job last week. So long-term unemployed are not really a very effective substitute for the employed. And it's argued that as a consequence, as unemployment rises, this so-called natural rate rises. Because you've got this, if you like, and I'm not trying to disparage the long-term unemployed, you've got this dead wood, which are having no effect on market processes because they're really not competitive in the labour market. So when you do get a recovery, you actually find the natural rate falls. And as I say, when you get a downturn, the natural rate increases, rather than the natural rate being constant. And the other key factor in trying to understand the forces driving inflation, of course, is underemployment. And that's something that Coffey was aware of a very long time ago in terms of research, and the Reserve Bank, or rather the ABS, finally sort of came to terms with the fact that they should be measuring underemployment. And when there's commentary about the latest labour market figures, and we had some last week, typically there's discussion of underemployment. So underemployment is a moderating influence, because here we have people who are working already, have presumably demonstrate that they are competent at what they're doing, and if firms want to hire more labour, they would seriously think about increasing the hours of the underemployed. So these ideas actually give rise to the notion, which has some serious empirical support, that in fact there is a long-run trade-off between unemployment and inflation, purely because the natural rate is not fixed. And as governments try to promote higher employment by whatever means, inflation will rise, but it won't accelerate as in the expectations augmented Phillips curve. So this so-called barrier, this natural rate, actually isn't a barrier because it does adjust. It doesn't just adjust instantly, so you do get higher inflation as unemployment falls, but inflation is not accelerating. It just is simply higher and stable, and then it can be higher again at a lower rate of unemployment. So the basis for the expectations augmented Phillips curve is now under serious threat. I haven't talked anything about modern monetary theory. Let me just very quickly mention key features of modern monetary theory, which you've probably seen before. The idea of the principles of chartalism and functional finance being central. And what I always emphasise is the importance of what is referred to as institutional practice. And this is how the key institutions, central banks, treasury and commercial banks, how they actually behave. Because if we're trying to understand the macroeconomy, we shouldn't go to a dusty textbook which emphasises the quantity theory of money and other arcane theories of money when it's completely at odds with what banks, say the central bank, does and actually says it does. And I mean, central bank websites are very informative about the way they behave. Chartalism is based on the view that money has its origins in the desire of the state to affect economic activity. We need to understand the idea of a fiat currency. Governments say, right, the legal tender is Australian dollars for transactions in Australia. It defines the so-called unit of account, but of course the currency has very little intrinsic value from the point of view of what makes up the production of a $5 note. So of course it's worth $5 because it's accepted that it can buy $5 worth of goods, but the actual piece of paper is worth or cost very little to produce. So why does it have value? Bill probably discussed this a few weeks back. It's the fact that the state has the capacity to impose taxes in that currency, which gives it value. And the state, as the monopoly issuer of the currency, can buy goods and services which are denominated in that currency. From the point of view of policy, functional finance is really fundamental. And here we're obviously moving towards fiscal policy away from monetary policy. Fiscal policy, that's treasury spending and taxing, according to functional finance principles, which were introduced by Lerner a long time ago. Fiscal policy should be adopted to counteract fluctuations in the economy and to secure full employment and price stability without worrying about deficit and debt. So that's a very fundamental principle of modern monetary theory. There are some provisos on the operation of functional finance. It's not sufficient that a country simply has its own currency. There are other conditions too, which I'll come on to. Okay, I better get moving. Okay, I want to talk a bit about the operations of the central bank and then the actual I'm talking about liquidity management. I'm going to show how a central bank responds to an increase in government spending, which will sort of kill a couple of birds with one stone. Okay, the central bank must keep the financial system operating, and that means banks must have sufficient liquidity to meet customer needs. And what I mean by that is that customers can draw down their accounts by going to an ATM and drawing out cash. So clearly the ATM's got to be stocked with cash. And equally, they can use a direct debit card to transfer funds to a retailer from whom they have bought something. Now, one of the worst problems within a financial system is if it's believed that a particular bank is stressed and is short of liquidity and may not even be viable because it's made a lot of bad decisions about loans. So bank runs are something that the central bank is very aware of, and the politicians are very aware of too. And this came up in the immediate aftermath of the GFC when the Rudd government were in power, when they introduced a deposit guarantee. So you may think your bank has made some very bad decisions in terms of acquiring financial assets, but your deposits are safe. Maybe up to a particular limit, as is the case currently in the UK. I think at the time, the Rudd government, there was no upper limit. So you wouldn't get a bank run in Australia in the aftermath of the GFC. So in what form do banks hold liquidity? Well, they hold liquidity by holding so-called reserves. And these reserves consist of their deposits at the central bank. And the central bank is their banker. And of course, they equally hold vault cash, the physical cash that's in ATM machines. And they may have some, obviously, not in ATM machines within the individual branches. Now, if banks are short of reserves, and this would occur if their customers were having a spending spree, and we'll see why that's the case in a moment, then they've got two choices. They can either borrow from other banks, because there may be other banks that have got a surplus of reserves, on the so-called interbank market at the current rate of 1%. Now, this 1% is the so-called cash rate. This is the rate that the Reserve Bank announces every month, and last month this month, where are we now? Beginning of this month, they maintained the cash rate of 1%, whereas in August they had reduced it from 1.25 and they'd reduced it the previous month too. So when the central bank, in this case the RBA, announces the cash rate, it is saying effectively, this is the rate we want banks to transact at. In other words, banks lending to each other. There is another rate which is effectively set at the same time, and that is the rate that banks pay to the RBA if they borrow directly from the RBA. They'd obviously prefer to borrow from another bank because they pay 1% currently. If they borrow from the RBA, they pay 1.25%. Oh, yeah.
Does this happen very often, or is it just continuously, or just occasionally they have problems with this?
In terms of having to borrow from the...
The bank's running short of money. Is that very common?
Well, it's something that's kept very much under wraps, because any sort of hint that a bank is in trouble is threatening the stability of the financial system. So confidence in the system is all important. We don't know. No, exactly. Now, the other rate that's relevant is the rate that banks get from the Reserve Bank on their holdings of reserves, and that's 0.75%. So you've got three rates currently, and their levels are 0.75, 1, which is the rate that banks should lend and borrow to each other, and then the so-called discount rate, which is the rate that the RBA charges. So clearly the appropriate strategy for a bank is to hold as fewer level of reserves as possible, because they're only getting 0.75, lend their excess reserves to other banks overnight, and if they're successful in lending to other banks, they're going to get 1%, and avoid borrowing from the central bank, the Reserve Bank, at 1.25. A requirement on banks in Australia is they always have a positive level of reserves. Now, the central bank is the government's banker, and so treasury deposits are a liability of the central bank, just like our deposits in a commercial bank are a liability for the commercial bank, because you can go in and demand money out. In the same way, treasury deposits are a liability of the central bank. Now, it is important to understand how monetary policy is enacted. That is the institutional practice of central banks. Most central banks have a remit of not just keeping inflation low, but promoting full employment. And as we know, it's all about setting that key rate, the overnight interest rate or the cash rate. Now, what's immediately interesting is that in the absence of any other policy which is being used actively, such as fiscal policy, you've got two targets, full employment and low stable inflation, and only one instrument, in other words, monetary policy. And sometimes you suspect that the Reserve Bank is also being influenced by asset prices, in other words, in particular house prices. So being reliant on one policy instrument, monetary policy, when you've got a series of objectives which may not be consistent, clearly is a problem, or potentially a problem. As I say, cash rate is announced monthly, and then what the Reserve Bank does, and says it does, it has to engage in what's referred to as open market operations to ensure that that rate is achieved, that 1%. So banks borrow reserves from each other at 1%. Now, the important thing about the cash rate, or any rate set by the central bank, is it affects other rates. Not only rates on, say, public debt, but also commercial rates. Because investors have got choices in terms of their holdings of financial assets. And they can choose assets which mature in 12 months, or say a financial asset that matures in 5 years. So there clearly is a relationship between the rates offered by the issuers of those types of assets. Now, the fact that the short-term rate affects longer-term rates is highly relevant, because longer-term rates are important in terms of decisions about investment, private investment, capital investment by firms, and indeed consumption spending, and of course the prime rate, which is the mortgage rate. And you may remember that there is always the question after a change in the cash rate, is that change going to be passed on entirely to the mortgage rate? And going back a few years, it was, it wasn't immediate. If the rate was going down, banks would tend to spend a few days mulling over what they were going to do, save them some money. but bank mortgage rates would follow pretty well lockstep with whatever the change in the cash rate had been. So if it had been 25 basis points, which is the normal change, and it had gone up, then mortgage rates would go up at the same amount. And of course, in the last 5 years, that has changed. Banks say, oh, they've got funding costs which are growing. They've come up with some argument as to why they will not pass on a rate cut in its entirety. So it might be 18 basis points when the cash rate has gone down 25 basis points, that is 0.25%. Now, the other important aspect of monetary policy is that if interest rates are changed, then that may affect the exchange rate. Because if, let's say, we've got a cut in the interest rate, and that flows on to other rates to varying degrees, as I've explained, then Australian domestic interest rates are less attractive to a foreign investor because they've come down relative to rates in the US or Britain. So foreign investors are going to be less inclined to buy Australian financial assets. And this will actually, at least in principle, cause the dollar to depreciate. And that, under certain conditions, should improve net exports because our exports become cheaper. And of course, there's been a lot of discussion of countries generally trying to get their exchange rate as low as possible, because there are numerous countries with slow growth rates looking not to engage in fiscal policy, but rather if they can increase net exports, sell more goods overseas, then that's going to be good for employment. But you can't have all countries gaining a competitive advantage from pushing their currencies down. There's got to be, it's not that we're trading with Mars and every country in this world can reduce their exchange rate in relationship to Mars. Their exchange rates are compared to other exchange rates. So not all countries can effectively depreciate their currencies. Something that central banks do much more of now than they used to is to actually explain what they're up to and what they anticipate will happen, and that's referred to as forward guidance. And it allegedly provides more information and calms frayed nerves in financial markets. Now, I'm just going to very quickly talk about how a central bank responds to the situation where there has been an increase in, there's been a fiscal deficit, which is an additional net expenditure. And the reason for doing this is to explain how open market operations operate. In other words, how the central bank ensures that target rate is the rate that banks actually lend and borrow from each other. And it's worthwhile pointing out here that if you think about a simple transaction that you might engage in, then let's say you'd go and buy a phone, then you think, from your point of view, the transaction is over when you've submitted your debit card and the electronic transaction takes place. You leave the store with your iPhone and you anticipate very promptly your account balance will diminish by $1,000, let's say, and the retailer's balance will increase by $1,000. But what is going on behind the scenes is if the respective banks of you and the retailer are different, your bank is now better off because your deposit has fallen $1,000. So their liability is less. On the other hand, the retailer's bank is worse off because the retailer now has $1,000 more in the deposit account. So what also happens is that there is a transfer, albeit electronic, between your bank and the retailer's bank. Otherwise, you're going to have this imbalance every time you buy something. Your bank's going to be better off. And that's what the payment system is all about. And there are millions of transactions going on every day, and they're all sorted out by net transfers, electronic transfers between banks. Now, it's very important to understand what a treasury bond is, or the idea of a financial asset, and I've tried to very briefly explain here. So it's a formal contract to repay a loan with the interest rates, with the interest payments at fixed intervals. It could be every 6 months or every year. The borrower issues the so-called bond and sells it. The coupon is the rate paid on the face value of the bond, and it's written on the bond what the face value is. And if the face value is $100 and the coupon is 5%, then if you hold that bond, at the end of each year you'll get $5. So the important thing here is that the interest payment on this financial asset is a constant amount. Bonds are issued with different maturities, in other words, how long the bond will pay out your $5, and when the balance of the borrowing has got to be repaid, essentially the principal. Investors pay the issue price when the bond is first purchased, but then the bond's price will vary later when it's traded, because the fact you've bought a bond doesn't mean you have to hold on to it. You may sell it for more than you paid for it or less, depending on circumstances which I won't go into. And then, of course, the entitlement to that interest is transferred to the new owner. An important thing about treasury bonds is for a currency issue in government, they have zero risk. No doubt Bill would have mentioned that. So zero risk in the sense that the repayment or payment of interest will always take place because government is the monopoly issuer of the currency and can't run out of that currency. Now, in this very simple depiction of balance sheets for a central bank and the commercial banks, central bank holding treasury bonds, and liabilities include treasury deposits and bank reserves. On the other hand, if we look at commercial banks, they may be holding treasury bonds. Bank reserves is an asset for them, whereas the non-government sector deposits by firm, in other words, by firms and households, are liabilities. Okay, now, as I say, I'm in a sense sort of conflating the operation of how the liquidity management takes place by assuming that there's actually net spending going on from a deficit run by Treasury. So the politicians tell the Treasury to spend a certain amount, let's say $100 in net terms. So G is normal government spending, I times B is the fact there's outstanding Treasury bonds attracting the interest rate. So that's the interest payments, and we take off tax. That gives you what the financial position is for the government in terms of this particular period of time. Are they running a surplus, in which case that would be negative, tax receipts being greater than spending plus bond payments, or are they running a deficit, in which case this would be positive. Now, we assume that Treasury needs to have a balance of 100 to enable that spending to take place, and we assume that it's possible to borrow from the central bank, just for illustrative purposes. Now, this looks highly intimidating. I hope it won't be as I go through it. Each of these three stages measures the change that has occurred. So the first change is that Treasury actually needs $100 additional deposits. So it borrows them from the central bank. So the central bank, the RBA, has now got Treasury bonds, an additional 100, and at the same time, the Treasury deposits have gone up 100 because the RBA has credited Treasury with $100 and it's got $100 of extra bonds. What happens next is that spending takes place. So the change in Treasury deposits is minus 100. So it's borrowed and then it's spent. On the other hand, the suppliers of goods and services to government spending, let's assume that the $100 is government spending as such, net government spending. People supplying goods and services to government, their deposits have gone up 100. And that means that $100 of extra reserves have to be credited to banks. Otherwise, the banks are worse off, merely because one of their customers or many customers got this net amount in. So bank reserves have gone up 100, and that's mirrored in the central bank position. So what has happened is central bank is better off in terms of Treasury, but worse off in terms of bank reserves, but it nets out to zero. So again...
Sorry, Martin.
Yeah.
In this step, where did the commercial bank get those bank reserves? How did it acquire those bank reserves?
They were credited by the central bank.
So the central bank credited... Okay, so they credited the commercial bank's bank reserves, and did the commercial bank then, as another operation, credit the person's account, which reads as a liability?
No, because Treasury would have done that or the, whatever the department was. Okay. So, I mean, the initiating force was the spending which led to, after invoices were submitted, the payments being made. And simultaneously, the reserve position was sorted out. But you see, in each case, if you look at the central bank, it simply changed the nature of its liabilities. Commercial banks have got more assets, but they've got more liabilities at the same time, which cancel out. So they're no better or worse off.
So, in other words, I'm going to call it two simultaneous transactions which emanate from the central bank. One goes to the commercial bank in the form of a deposit, and the other one goes into the commercial bank's reserves.
Yeah.
Right.
I mean, it used to be in the old days when one got a tax refund, you actually used to get a cheque drawn on the Reserve Bank, which you could take into a commercial bank, and you could immediately draw on it, which was interesting, which is saying the Reserve Bank can never go bust. Whereas if you take a cheque drawn on somebody's account somewhere nowadays, this has always been the case, it's got to clear before you can draw on it. So the Reserve Bank doesn't run out of money. Yeah, that is in terms of the money supply, that the additional deposits are, well, as I defined the money supply before, it's deposits plus cash.
And it's without liability.
Sorry?
And the money supply is without liability. Whereas bank money is also a liability. Because you paid the bill already, so therefore it's got no liability. The money supply has no liability.
I think I'll put that question aside for the moment.
If I can comment on this, I think that there are two entities which are not on this diagram for simplicity. It is the balance sheet of the treasury and the balance sheet of the private sector. And if we account for these, then each operation is a quadruple accounting operation, and then we can see what belongs to who, because these deposits belong to the treasury, and then they are spent to the private sector, but it is the balance of commercial banks against the central bank, which is counted as bank reserves. So it is creation of currency in this case, because it's not creation of bank money. It's currency. It is government money which is created there. But we can draw everything, but it would be even more complex.
Yeah, we certainly can look at, as you say, the position of the private sector. It's engaged in work and its deposits have increased. That we don't want to draw another picture or another table. Now, what I want to highlight here is the increase in bank reserves that commercial banks have. And the scenario I'm painting in stage 3 is, in fact, the commercial banks don't want $100 of additional reserves. That's more reserves than they need. So the question then is, what happens? Well, what happens is, if the central bank ignores this, then what do the banks do with this additional $100 when they only want, as it turns out, an additional $10 of reserves? What they'll do is try to lend it out to other banks. But the point is that what we're identifying here is a system surplus. The banks collectively have more reserves than they want. And if the central bank doesn't intervene and do something, take away by some means that $90 excess, the interbank rate will fall. So there's more supply of reserves than demand. So what the central bank does is to sell $90 worth of treasury bonds at a rate which is higher than the interbank rate, the 1%, the cash rate. And banks who've got $90 of excess reserves are very happy to buy treasury bonds. So the next stage is that treasury bonds drop 90, and as correspondingly bank reserves drop 90. Commercial banks take on extra $90 worth of treasury bonds, and their reserves get reduced by 90. And the downward pressure on the interbank rate is being averted. And this is precisely what open market operations are. And if you go to the Reserve Bank website, this is what they talk about, what they do on a daily basis. They've got to try to anticipate whether banks have got more reserves than they need or less. If they get it wrong, and they claim they never do, because they can actually come back late, this all starts about 9 o'clock in the morning, but they can come back later in the day and make some changes if they've wrongly anticipated what's going to happen. So pretty well always get it right, very close to right. And as I say, these are open market operations. And it's all about maintaining the integrity of monetary policy. The interbank rate's been set at 1%, and in this scenario, in the absence of doing what they're doing here, stage 3, the interbank rate would fall. and it could fall as low as 0.75, which is what banks get from the central bank on their reserves. So this is a crucial stage in terms of what the Reserve Bank does, but it's not something it can decide that it's going to sell debt of 80 or 60 or whatever. It's driven by the needs of the banks. And this, in a way, explains why they couldn't control the money supply. They have to be accommodating. Yes, they can make the decision about the 1%, which is allegedly independent, because you've got these disinterested people sitting around the table on the first Tuesday of the month. But they can't really do anything about this sort of issue. They've simply got to say, all right, we've got to sell some debt, otherwise the interbank rate will fall.
Does it reverse when the commercial banks will sell the bonds back?
Well, the bonds will ultimately expire. They may obviously sell them in the interim, and I don't think I want to go to that stage at this point.
It just seems like the bank is obliged to have like a 10%, gain in that system, unless something goes back the other way, because the bank reserves end up being an extra 10 at the bottom, don't they?
Yeah, but you see, the point is their assets have risen by 100 in a slightly different form than they were earlier, and their liabilities are 100. I mean, that's the key. I mean, there's no reason the bank should be any worse off from these sort of transactions. And similarly, the central bank isn't any better or worse off. It's just changed the composition of its asset, or in fact, a quantum change in the amount of additional assets and liabilities. So this last row adds up the flows, the changes over those three stages. So the Reserve Bank has got extra $10 worth of Treasury bonds, extra $10 worth of reserves, which is just, again, from adding these up. And correspondingly, the commercial banks have got an extra $10 worth of reserves, an extra $90 worth of Treasury bonds, and nothing's happened to the deposits of the non-government sector since the initial spending by the Treasury. So this is just really summarising what I have just been saying, that the Reserve Bank had to do that to avoid compromising monetary policy. What is interesting is the running of a deficit actually puts downward pressure on the interbank rate. And the conventional wisdom amongst orthodox economists is if government net spends, it's going to actually add upward pressure to interest rates. And this clearly demonstrates that's not the case. Right, moving on. I shall leave that slide other than to say that if we look at the relationship between the deficit and the change in the so-called monetary base, which is the $10 of additional reserves and the $90 worth of additional bonds, there is a question as to the interpretation of what that equation means. An orthodox economist get it wrong because they think it's government trying to decide in advance how they're going to finance net spending by government. Let me just focus on this last paragraph, which says essentially this is the accommodative behaviour of the central bank. It's got to achieve that target rate. If it doesn't sell those bonds, then there's going to be trouble in terms of the rate going below the target. Okay, now, and I must be very brief here on in. As we probably can recall, the response of countries to the GFC was a response in terms of lowering official rates. In other words, Australia lowered the cash rate at a rather slower rate than other countries because we were not very much affected. Briefly, fiscal stimulus measures in major economies, US, UK and Australia. Not long-lived because there is, of course, the, if you like, the politics of responsible fiscal management. And that is the idea that deficits are bad, they lead to higher government debt, and how dare we leave more debt for our children who are going to have to pay it off, etc., etc. And the other problem is potentially we're going to get increased inflation from higher government expenditure, as was illustrated by the expectations augmented Phillips curve. So, serious cuts in the official rates. Countries realised that conventional monetary policy hadn't really worked, and they adopted quantitative easing. And that's very much premised on the idea that there is a zero lower bound for the interest rate. In other words, it doesn't go below zero. When the USA introduced quantitative easing, it effectively had a zero interest rate. In the UK, the lowest the bank rate has gone to is 0.25. For a long time it was 0.5, which from March 2009, and that seemed to be the lowest it was ever going to go. But they introduced quantitative easing and in fact later actually cut the rate. Quantitative easing, I show on the next slide. So what's quantitative easing? Well, what happens is that the central bank buys bonds from banks and pension funds, and typically buys longer-term bonds. And if you go back to my example of a bond costing $100 and paying $5, because the interest rate written on the bond is 5%, if an extra player comes in, like the central bank, and buys a whole load of 10-year bonds, the price of those bonds inevitably is going to go up. And what that means is that the yield, the rate of interest now being earned, has fallen. So in other words, bond cost initially $100, $5 paid in interest every year. Because a big player comes in and buys a whole load of that particular maturity of debt, if the price goes up to $125, 5 divided by 125 is 4%, not 5%. So an increased demand for a financial asset lowers its effective yield. So in other words, what quantitative easing does is not to say, well, we'll hit the very short-term rate and pray that it'll have an effect on the long-term rate. Here we're directly, through the central bank, impacting on the price of a 10-year bond, 15-year bond, whatever, and driving down the yield on that by pushing up its price. And that will impact on commercial rates, long-term commercial rates. And what one's in fact trying to do is to flatten the so-called yield curve, and I'll show you a picture of the yield curve in just a moment. Now, you could say QE smacks of desperation. You've pushed the official rate down to near zero or near zero. Monetary policy still doesn't appear to be working, so we're now going to hit, the particular long-term rates, 5-year, 10-year rates and try to push them down a bit more and pray that the real economy, consumption, investment and so on, will actually raise activity. And of course central banks have had this fundamental problem of low inflation, and so they've got to try to stimulate the economy by reducing interest rates and getting those impacts through the real economy of higher spending. Is the zero lower bound the effective lower bound for the policy rate? Well, the answer now appears to be no. Countries have introduced negative rates, and if you're a bank and your reserves attract a negative rate, then the presumption is that you'll lend more money to credit-worthy borrowers. Because why would you want to hold reserves paying a negative rate? And unfortunately, banks don't use their reserves to make loans. What banks do is they may have somebody come in to see them. They try to work out whether they're credit worthy, that there's some prospect they'll repay on time. They will assess that they're going to make a reasonable return in respect of the rates the banks pay and the rate that the customer is going to pay. And then, irrespective of their reserve position, they will lend, and then they'll worry about acquiring additional reserves. So that's how banks make decisions about lending. It's got nothing to do with whether they've got enough reserves or not. Now, I have a bit of discussion about negative rates, which I'm not going to go into detail about because of the constraints of time. But there's clearly an interesting question if deposit rates start becoming negative, how people are going to behave. And it seems to me that even if you were paying 2% on your deposits rather than being paid 0.5%, it's still very convenient having a bank account for transactions purposes. And I talk about, well, if you've got a direct debit card, very convenient for transactions, you've got to have an account. You can't have a direct debit card without an account, in which case if there were significant negative interest rates, you would be paying the bank. Now, you're paying the bank typically already in the form of fees and charges. So there's a question about at what point, when interest rates get high and negative, at what point do you say, I don't want a bank account anymore? In which case you would draw your money out. Now, what is exceedingly interesting is the IMF are talking about deep negative interest rates. And what that means is, as far as various orthodox economists are concerned, there is no constraint on how low rates can go. And then they have a very fundamental question to address, and that is how they deter people from closing their accounts. And the solution, as far as the IMF are concerned, and if you want to read about it, there is a document of 91 pages explaining how you do that. But the essential point is you've got to tax, or rather impose a negative interest rate on cash. And that's actually quite complicated. Now, I don't claim to have got to the bottom of that yet. Lots of reading to do. Neither the Fed Reserve nor the RBA seem interested in negative interest rates. The RBA is hedging its bets on unconventional policy because we don't have QE, of course, here. Tim Wilson subjected the RBA to a series of questions in Parliament. Again, the idea of deep negative interest rates is about, well, monetary policy really does work, It hasn't worked yet. We've tried the orthodox conventional policy, we've tried QE, and now we've got to break through the zero barrier, this asymmetry, where you've got this lower bound, and crash into negative territory. And then we might get some traction in terms of an effect on the real economy. We've got low inflation, it's below the 2 to 3% band, and we need to do something about it. Now, I have a discussion about the job guarantee, etc. That is beyond my remit at 10 to 4. Let me just make the point that there's a very interesting article in The Guardian, which is online, where Jericho, who's a main economics writer, interviews 3 people about what should be done about policy in Australia. And one thing that comes through very strongly is that Philip Lowe's failed because he hasn't got inflation within the 2 to 3% band. It's too low. And the point is made in the UK, if the Bank of England doesn't do what it's supposed to do, then a letter has to be written explaining why it hasn't been achieved. So the argument, which is in terms of the logic of the 2 to 3% band and the responsibilities of the Reserve Bank, is that monetary policy has been too tight. So we should have had more cuts than we've had, because they haven't worked, which doesn't surprise me. And as a modern monetary theorist, fiscal policy is much more predictable and can meet some very important social and economic goals, not only full employment and price stability, but all sorts of public expenditure that's got to take place. When I start talking about public expenditure, I think of The Affluent Society by J.K. Galbraith, when he talks about private affluence and public squalor. And unfortunately, that's precisely what we've currently got with the neglect of infrastructure and so on. Anyway, I shall stop there. A bit short of where I was going to end, but I don't see it's useful to keep rambling on and time running out. So I'd certainly welcome questions.
Just so people are aware, anyone who reads the Saturday paper, there's a very good letter in today's one by Daniel DeVos in Brisbane on the low Morrison and Frydenberg. It's very good.
Right, okay.
I have tried a different take on add to what you've been saying.
Yeah.
Is that the world economy was productive until about the 1970s, and then it switched to credit. And that all seemed to coincide with the beginning of monetary policy and things like that, and Friedman and so on. I wonder if there's a direct link to those.
Sorry, it shifted to credit, did you say?
Yeah, well, we started borrowing a lot more than we were producing. You know, in order to keep the economy growing, you needed to go into debit credit rather than have production, which was fundamentally feeding the economy enough reserves to grow, and then they had to borrow money to keep going. And that was a changeover that the economy actually peaked in about 1970. That's what I call it the time of the moonshot. The economy that we had peaked in, from there on it's all been in decline, and it's been made up by borrowing. And that's been encouraged by, and that's why we see a lot of the troubles we've had since then. This is not sustainable. And it's going to eventually, I mean, the government doesn't have really any debt, but the private sector's got enormous debt.
The private sector certainly has very high debt, that's true.
So it's more or less that we've become a non-productive economy. A lot of money just spent on Chinese knickknacks, which is keeping people in jobs but not producing anything worthwhile. And you look at a lot of these graphs and the decline over time to now.
certainly there's, the deregulation of the financial system over a period of time has led to significant amounts of credit creation have gone on. And as you're also saying, I think the ideal for a well-run financial sector is that the credit creation is actually financing investment, physical capital investment.
It's just going into the fire sector.
Well, it's going into the fire sector, being financial insurance and real estate. So it's not only existing physical assets like houses, obviously, but also financial assets. And I think, well, that's a very valid criticism that it's misdirected. It's led to an enormous expansion of the financial sector, which is largely unproductive.
The MMT can actually make quite a difference there.
Yes, well, that's true, yes.
And you carried on.
Well, I think it's it's fundamental in terms of what our view of a decent society is, which is a society where there is individuals are looked after, but we live in a pleasant, efficient in terms of public transport, physical environment. So there are public spaces, which are not dangerous and are pleasant and all the rest.
My definition of neoliberalism is predatory capitalism.
Yeah, well, private affluence, public scholar.
I'm curious about if you might comment on it. During the GFC, as I see it now, and I had no clue at the time until Swan published his memoirs, which I flicked through. But Ken Henry seemed to be the driving force there, and Rudd and Swan nodded and smiled. Fortunately, is this a rough sort of caricature
Of the fiscal stimulus measures?
Our fiscal behaviour here, our fiscal policy here. Firstly, the fiscal stimulus can be identified in the national accounts. So it had an effect, and you expect that about fiscal policy, particularly the way you measure GDP. I mean, fiscal policy may involve spending on totally useless items, but that will appear in GDP. The problem with Rudd and Swan was their urgency to get the insulation scheme going, etc., etc. Schools having 3 halls rather than 1. So it was very badly planned. The principle was right, but the actual implementation was terrible. But they were very soon talked out of any further stimulus, because the power of saying, look, this is in the long term is catastrophic in terms of debt and deficit. That was very, very important in the sort of political debate. There is an urgency in that situation. Do you think they could have, it's hypothetical, do you think they could have moved more slowly, or could they have moved more slowly but better? Or
Well, I mean, they had other schemes going which involved sort of lump sums being paid, I think, on the basis of your last tax return. There were dead people who were being sent cheques, which probably didn't help them very much.
I did it like average because I got a $38,000 cheque from them. Because I retired at 71 instead of 65. And for every year on, they gave you a thing that went up to $38,000 from about $200.
Well, you're very lucky.
I made a lot of debts.
Yeah. No, I mean...
we dodged a few bullets, though.
We did.
Flawed as it was, we did. Right?
Yeah, and other countries did the same. Now, in the article by The Guardian, they talk about people's QE, which is... it's fiscal policy, but it's dressed up as QE. and essentially it doesn't require debt issue, which I can explain if you want.
Would that fall under that UBI definition sort of thing? No?
I mean, it could do. I'm
not advocating for
no,
it,
no.
I'm just saying that could be another, that I've just lost my train of thought, sorry.
Well, clearly you could, as the Rudd government did, on the basis of some robust criteria, decide to simply hand out sums of money.
And just letting the people spend it. That sort of mentality.
I mean, the term helicopter money, used to be used by Friedman, and he literally meant dropping money, and whoever was lucky enough to pick it up would have been,
we picked it up.
I'd just like you to clarify perhaps this point. When you speak of stimulus of any description, that stimulus is always implicitly applied to the activities of the private sector. Things go up, things go down, we have natural disasters, we do or we don't trade, all this sort of business. Something that seems to me always absent from the discussions, just from the sort of information you provided us with, we've got a great big slab of the economy which is in fact ongoing. And it's ongoing the whole time, and it's called a public service, and it provides us all with services. And yet when we talk about all these economic theories, the public sector itself, which doesn't vary, I mean it can vary if you spend more on it, but it's this great big monolith of a presence upon which we all depend. And every time you look at a graph or a bank statement or all the information that you so interestingly presented us with, absent from the whole discussion is the public service. Could you sort of elaborate that? I'm talking about the sort of models that you're using and the idea of stimulus when it all seems to be to do with the private sector, and the public sector employs like a quarter of the people in the real economy, as the term is,
Yeah, okay. If I'd had time to discuss fiscal policy and job guarantees and so on, I would have said that there is a role for a job guarantee as a stabilisation policy. That does not preclude increased government spending, employing people at the market wages, and that can include more being spent on the health system, more being spent on education, and so on. More research grants being given to universities, and that sort of thing. So, I mean, I would, in a reasonable, lengthy discussion about fiscal policy, I would not be inferring that it's always got to feed the private sector. I would be saying, look, there's a whole load of areas where the public sector is not doing very well, typically because it's under-resourced.
Isn't it interesting, though, that the term stimulus, that in economic discussion you keep using, or economists keep using the term stimulus, in terms of the private sector, interestingly, we never seem to hear about the public sector requiring a stimulus.
No, well, I think you're right, and there's part of it is that the public sector is viewed as unproductive.
Not part of the real economy.
Yeah, and any sort of job creation policy by government is clearly creating make-work jobs.
Police, ambulance, nurses, hospitals,
Yeah, and I mean, politicians are public servants too. So when they berate the public service and talk about make work and unproductive, they should also be referring to themselves. So. Well, it is. That's right.
We just have time for one more question. That's all right.
I got it?
Yeah.
The advocates of the day that were advocating for banking deregulation and liberalising the financial sector, was the inverse effect of that reducing the power of the Reserve Bank to manage the economy? taking away its controls or its ability?
Well, I mean, there are other agencies as well,
Yeah.
you know, that play a role. I mean, I think sorting out which agencies are responsible for what, you know, would be important. So yeah, I mean that's really as much.
Yeah. Would have Milton Friedman been a cheerleader for banking deregulation?
Oh, he would have been,
Yeah.
undoubtedly. But you know, there shouldn't be constraints on lending. I mean, the risk is with the lender.
Yeah.
So, yeah, no, I think he would have been definitely, and obviously flexible exchange rates, but the irony is, of course, modern monetary theory relies on flexible exchange rates.
Just in my history, you know, I mean, because I go back to, well, my history of 1990, I've ever known the Reserve Bank to only ever reduce interest rates. And when they reduced interest rates, the private market just went, well, we can lift all our borrowings up because we can now turn the accelerator up on our borrowings because our asset values go up. If the Reserve Bank lifts interest rates, it's effectively like, well, raising inflation for the consumer level, isn't it?
Well, clearly interest costs for firms go up. Whether they pass those interest costs on is moot. But you know, when you're thinking of interest rates increasing, then you can argue that some people clearly people benefit from high interest rates.
Yeah.
Pensioners and the very wealthy do, and conversely, of course, when we're relying so heavily on interest rates, then pensioners miss out, and they've got a valid, you know, complaint, which means, you know, pensions need to be thoroughly revisited. So,
thank you.
Thank you very much, Martin. And